You're watching Bloomberg UTV.
If volatility is something that's keeping you away from investing in these markets, well, worry not. If you want to play it safe when it comes to a mutual fund portfolio, we have the best picks within balanced funds.
Balanced fund is for everybody. It's a way to have a professional fund manager allocate your money between equities and debt.
It's a season of new fund offers. SBI PSU Fund, also the Canara Robeco Indigo NFO. Which one should you buy? Which one you should avoid? Smart Money will give you a 360-degree perspective. And if you are looking at settling down in a shack in Goa, grow apples in the Himalayas, or perhaps like Arjun Chatterjee, make a movie at age 45, we'll tell you how to retire rich in this episode of Smart Money.
By the time you retire, my estimate would be your net worth from a retirement pool standpoint would be in the ballpark of 3 to 4 crores.
Clearly, these are risky times. In these markets, a lot of analysts are telling you they don't know the direction in which these markets are going to go next. Well, how do you invest in these markets? How do you put in money? Balanced funds, are they the way to go? Radhika Gupta from Forefront Capital Management joins us on Smart Money to tell us exactly that. Radhika, what do you say? Balanced fund, who is it for?
Balanced fund is for everybody. It's a way to have a professional fund manager allocate your money between equities and debt in risky markets without you having to worry about how to do it.
Right. Then how do you decide how much money goes into a balanced fund when it comes to your entire portfolio?
There are two approaches you can take. If you're a more risk-averse investor, rather than doing any equities at all, you can just park it in a balanced fund and feel that your money is safe. Otherwise, you can park 50% of your portfolio in an equity fund and maybe 30% in a balanced fund, which is more safe.
Also, the returns, if you look at the last 2 years on balanced funds, it has been 7%. If you look at equity diversified funds, it's 5%. So clearly doing more and more NFOs coming in the balanced fund space than the equity funds route. So do you think this interest is rising for balanced funds? The demand is increasing there.
I think the demand and supply is increasing and will continue to increase. As you mentioned, markets are volatile. People don't know when to invest and how to invest, and this is just the solution they need.
All right, let's see what Radhika is suggesting by way of options within the balanced fund space.
Birla Sun Life 95 Growth seeks to achieve long-term capital appreciation and current income from a balanced portfolio. The fund's target allocation is 60% equity, 40% debt and money market securities. Satyavrata Mohanty has been handling the fund since June 2009. Mr. Mohanty is a Bachelor of Commerce and a Chartered Accountant and has been with Birla Sun Life AMC for more than 4 years in the area of finance and fixed income research. DSP BlackRock Balanced Fund is a fund for investors who worry too much about volatility. It upholds its large cap bias but is not averse to smaller stocks as well. On the debt side, the fund tries to keep risk to its minimum by sticking to high quality and low maturity paper. Apurv Shah has managed the fund since June of 2006. Mr. Shah has a postgraduate diploma in management from the Indian Institute of Management, Ahmedabad. Prior to joining DSP BlackRock, he held senior positions at DSP Merrill Lynch. HDFC Prudence Growth seeks periodic returns and long-term capital appreciation from a balanced portfolio of debt and equity. Prashant Jain has managed the fund since Jan 1994. Mr. Jain is a BTech from IIT Kanpur, PGDM from IIM Bangalore and CFA from AIMR USA. Prior to joining HDFC AMC, he has worked with Zurich AMC and SBI Mutual Fund.
Now, those are some funds that you could look at adding into your portfolio if you're looking for balanced funds. The first one that we're talking about is the Birla Sun Life 95 Fund. Now, Radhika, if you look at the debt outlay for this fund, it is on the higher side as expected. A lot of exposure to government securities. Also, when you look at the northward movement of interest rates with so much exposure to debt, should I be worried if I have this fund in my portfolio?
Yes and no. The good thing is that it's government securities. You're not getting housing finance or auto loans. So that makes me feel very good about the quality of debt you've got exposure to. If you're holding it in the long term, government yields should not move that much.
The top 3 holdings over here are in the debt space as well. So keeping all of that in mind, nothing to worry about, you're saying?
Nothing to worry about, really.
Radhika, the second fund that you're talking about is the DSP BlackRock Balanced Fund. Not a great performer, especially when you set it aside Tata Balanced Fund or even Reliance Regular Savings. Year to date, it's underperforming what Reliance Regular has been able to give. So why are you suggesting this and not Reliance Regular?
It's been around for 5 years, longer than Reliance and Tata, and had a chance to prove its ability over a long period, which is important for a balanced fund. Over the last 5 years, it's been the number 2 performer in the space, and Apurva Shah has a very strong investment track record.
But why not Reliance Regular, really?
I think it's been around shorter, and I like to look at balanced funds that have had a 5 to 10 year history so that they can show performance in all kinds of market cycles, bull runs, flat markets, bear runs.
Fair enough. HDFC Prudence Fund is the third fund that you're suggesting. Now, over here, besides HDFC Prudence, there's another fund from the same AMC, and that is HDFC Balance. Now, what really is the differentiator between these two? Though we can easily see that HDFC Prudence has done better.
HDFC Balanced was launched a little bit later with the aim of being a less conservative fund than HDFC Prudence, as the name suggests. That said, that hasn't played out in practice. HDFC Prudence has done a much better job. And Prashant Jain, who's one of India's best fund managers, has been behind the fund, and it's consistently delivered.
And Radhika, among these 3 funds, if you're looking at just one, if you don't want too much diversification, which one would you go with?
Undoubtedly HDFC Prudence. 17-year track record, great fund manager, great performance, good fees.
Radhika, thanks very much for joining us with these ideas on balanced funds. I'm sure our investors have lots more questions to ask. If you do, send them across to us. Our email ID is smartmoney@bloombergutv.com. We've been getting a lot of questions on portfolios and funds that haven't been performing in those portfolios. What do you do with them? How do you weed them out? Can you make a switch? Well, here are some thoughts.
Ravi Nagrani is confused and he wants Smart Money to help him with his portfolio. He is currently investing in DSP BlackRock Top 100 Equity, IDFC Premier Equity and Reliance Regular Savings Fund. But there are some mutual funds he is not investing in anymore. These are DSP BlackRock Tiger, Fidelity Equity Fund, Franklin Flexi Cap, HDFC Tax Saver, ICICI Pru Dynamic Plan, ICICI Pru Infrastructure, ICICI Pru Tax Plan, SBI Magnum Tax Gain and Sundaram Select Mid Cap. He wants to know what to do with these funds. Keep it or junk it. Radhika suggests you keep DSP BlackRock Tiger, HDFC Tax Saver and ICICI Pru Dynamic Plan. The funds you can junk are Fidelity Equity Fund, Franklin Flexi Cap, ICICI Pru Infrastructure, ICICI Pru Tax Plan and SBI Magnum Tax Gain. Radhika has also suggested you switch your investments from Sundaram Select Mid Cap to Birla Sun Life Mid Cap. You could also get out of Reliance Regular Savings SIP and move to an HDFC Top 200, which is a better fund in this space.
All right, so if you have questions on funds that haven't been performing in your own portfolio, write to us about it, smartmoney@bloombergutv.com. We take a very quick break. On the flip side, a new segment. We call it Retire Rich. Here on Smart Money at the age of 27, Arjun Chatterjee wants to look at retiring rich. By the age of 45, in fact, he wants to have a film of his own. Can he do that? We'll answer that question on the flip side. Stay with us. Hello again, the show is Smart Money, where we tell you how to play your investments right so that you're building wealth over the long term. And many people have been approaching us, asking us, how do we retire rich? We're starting a new segment. It's called just that. And Arjun Chatterjee is 28 years old. He's asking us, how does he retire rich? By the age of 45, he wants to follow his passion. Let's meet him.
No, this is not another tale of peak in the past, but a dream that 28-year-old Arjun Chatterjee wants to fulfill. And that's to make a movie when he turns 45. He wants to retire rich. An entrepreneur by profession but an aspirant movie producer at heart, Arjun's short-term dream is to buy a house and get his business up and running. But he feels his heart lies in the world of cinema.
Probably a long-term vision or long-term pipe sort of a dream, a smoked up sort of dream would be to, try to make a film. And it's not completely a pipe dream, because the way it is my own sister, Arpita Desai, she's a script writer. Her first script was Bheja Fry. My brother-in-law is Sagar Desai. He's a composer. He's done The Japanese Wife, so he got a lot of good reviews for that. My cousin's husband is a singer. Very close friends are assistant directors. Very close friend is a DOP. Since we have all these people here, all it takes is to, organize everyone in together and, make a film which is more for its own sake than to be like a Bollywood blockbuster or something of that sort.
An MBA from XLRI Jamshedpur, Arjun is an ambitious guy who gave up the lucrative corporate world. Why? Because he found it boring.
I'm a very bad board worker, okay? Even in any kind of a job situation. Again, there were system-related constraints which are always difficult to overcome. And when you have a larger overview of it, and this is my general belief, that you end up probably causing more ruffles in the system. You'll probably add some value. I'm not saying it's a negative value, but you'll probably end up causing more ruffles than adding value.
Arjun's boredom and restricted freedom at work led to his decision of starting his digital consulting firm, Runtime Solutions, in January this year. Set in a quaint and very un-office-like setup, Arjun has a small 3-member team. But as you enter the office, some things are absolutely hard to miss. The laziest member of Arjun's team, Mac, and of course, his love for movies.
That's Runtime Solutions, what I've just started now. I'm running my own business now. The eventual goal is to make a movie. That's why I still have these posters here. Sholay, Mughal-e-Azam, the blockbusters. And, keep the whole enthu and the dream alive. Maybe one day our film will also be a poster that people collect and put up on their walls.
And Arjun Chatterjee is right here with us here in Mumbai Cricket Association. We're sitting down with a wealth manager. He is from Stanchart and his name is Vishal Kapoor. A very warm welcome to you, Vishal.
Thank you.
And Arjun, you're the one with the big dream. You want to retire rich. Tell us why.
Doesn't everyone, as in, that's the big dream.
That's right. You've already launched yourself in a career.
I have.
You are working in a job situation and now you've set up something of your own.
That's right. I've been working for the last 6 years. And after 6 years of working in the digital space, I thought, now's the time that I can actually branch out and do something of my own. So, that's what I feel is the first step towards getting rich first and then retiring rich. I believe that's how the process happened. I mean, discounting Las Vegas and things like that.
So, well, those are routes as well, but not sure whether a wealth manager is going to suggest it.
Not recommended.
Not recommended, surely.
Well, the eventual dream at 45 is to make a film of my own, and hopefully it'll be a hit. And that's how I retire rich.
That's how you retire rich, huh? Well, let's just understand what Arjun brings to the table right now to be able to devise a plan for him to reach that situation in his life where he doesn't need to work for money.
So here's what Arjun brings to the table. His monthly income is 60,000 rupees. His monthly expenses add up to 30,000. By way of investments, he's got about 1,60,000 rupees in mutual funds and 4 lakh rupees in Provident Fund. He has 2 insurance policies, ICICI Prudential Lifetime Gold, towards which he has contributed 1,50,000 rupees, and ICICI Prudential Flexi Balanced, for which he's paying an annual premium of 50,000 rupees. Arjun also has 2 ULIP plans. The total contribution is 60,000 and the sum assured is 1 lakh rupees.
So Arjun's got some investments going so far, Vishal.
I think, he's got a good start. That's the good news. Yeah. You've got, a savings rate which is healthy at 50% of your income. And that's a good rate to keep, I think, as you go up. So your expenses are under control, which is great. But I think we've got to work from basics up in terms of, first of all, protecting you. You could choose between some health plans plus some term covers to really top up what you've already got. Right? I think once we've got our risks covered, we can move more confidently ahead to build up our investment pool.
Right.
Yeah?
So how much money does he need to put in right now towards insurance so that we have that base covered?
Right. I think, at your current, annual income, which I will put broadly at about, 10 lakhs, right? I think the minimum term cover you've got to have is a crore, right? Ballpark, rule of thumb, 10 times, right?
Absolutely.
I think once we move out of that, we've got to start looking at planning for a home, right? I noticed that you're on rental right now.
Right.
I think it'll be a good plan if somewhere down the line we could substitute that rent with EMI on your own house. Now, it may seem, Arjun, to be honest, that you are taking a bit of a lifestyle dip right now, because to be honest, the cost of rental right now is much lower than the cost of buying.
Sure.
But, in the long run, if you've not got your own house, you're not doing a good job.
And that
of your
thought
planning.
hasn't crossed your mind?
Of course it has.
Yes?
It's been something I've been
So that's
aiming
almost
towards.
an immediate goal, I'm sure, to
course.
have your own place.
It is. It's something I'm working towards. Interesting point that Vishal brought about the lifestyle dip.
Yes.
Given Bombay, the area where I want to buy a house, vis-a-vis the affordability of where I can buy a house, given my budget, is in constant conflict.
Always a problem, isn't it?
Always
So-
a problem, absolutely. And so you could always be keeping the rent, but as long as you've got property that you may yourself be renting out, it
Right.
can offset.
Right.
Right?
Oh,
So you
that's
don't
always an
necessarily
option.
have to live in.
Sure.
You can always be
Agreed.
buying something that you think is affordable and rent it out, make it productive.
Absolutely.
Right? So the good news is that we'll help you achieve all three, which is save for retirement and have a rich retirement. Second is to get yourself a house. And the third is to try and fund that movie that you want to make at 45, right? And the way we'll help you do that is, firstly, we're going to cover the basics. And the basics are get yourself adequate coverage from insurance while you still have age on your side, right? The second is we're going to first focus on your retirement plan. Let's build up that corpus and use the power of compounding in your favor. And the suggestion for that would be, let's take the bulk of your savings today, which is about 30,000 rupees per month, and put it into a systematic investment plan in a portfolio that is biased towards being more aggressive right now. Over time, we will moderate it. What we'll do next is, remember, your income is obviously also going to go up, right? So let's not get stuck up with our current 60-30, right? The 60,000 that you're making right now, at the same level of inflation, it works for you, in a couple of years, will be, to my estimate, more than 1,50,000, right? Guess what you've got? You've still got the same 40-50% cost ratio, right?
Right.
But you've still got about 75,000 rupees that you can save. The first 30 has been stuck into the SIP, and we're going to keep it there. Right. But that frees up another 45,000 rupees. So now you have another savings of 20 to 30,000 rupees coming up. Again, I would say put that into maybe a top-up of the SIP, because what that will do is build up that equity further. By the time you retire, my estimate would be your net worth from a retirement pool standpoint would be in the ballpark of 3 to 4 crores. Right? 3 to 4 crores is, then you have choices. Okay, do I want to produce this movie and then put 20% as equity, or do I want to put 10% of equity, etc.? So, you've got choices at that point in time. So, yeah, keep it simple. I think it's a very, very simple plan, but can be as effective, if not more, than some of the very complex things that we can also do for you.
Right.
Yeah?
Right. And when a wealth manager keeps it simple for us, it's always very welcome. Arjun, we hope you find this useful, building up your plan and living your passion, which is to create a film by the age of 45. Good luck with that, going ahead from here, and keep us posted on all these developments. I'm sure you also want to retire rich. If you do, send us an email on smartmoney@bloombergutv.com. We take a quick break. On the flip side, we'll talk about new fund offers. We'll scan the news of the week, devise a game plan for you. Stay tuned. Hello again, you're with Smart Money, the show that keeps it simple when it comes to investments, because that's the way we believe that you build wealth. If you look at AMCs, they're in a rush to put out new fund offers before the 1st of July, which is why we see a plethora of them. Because after the 1st of July, whatever new fund offers come by, they have to wrap it up in a span of 15 days from the date that the subscription begins. So lots of fund offers. Which are the ones that you must consider, and which ones can you give a miss? We'll take a look at them, devise a game plan. But before that, the news of the week.
Filing income tax related queries including returns and refunds will get easier for you by the end of this fiscal. The Income Tax Department has decided to set up help centers called Aikar Seva Kendras at 12 cities. These centers will address the problems of taxpayers. At present, help centers exist at only 3 places in the country: Pune, Chandigarh and Kochi. The new centers would be set up at Ludhiana, Kolkata, Indore, Bhubaneswar, Guwahati, Surat, Ahmedabad, Udaipur and Coimbatore. So, redressal to any queries on refunds and returns will become that much simpler. Here's yet another positive attempt from Securities and Exchange Board of India or SEBI to ensure that investors are not missold mutual funds. SEBI has decided to put in place a system for distributors. This will include sales guidelines for all sellers of mutual funds, including banks, national distribution houses and independent financial advisors. For instance, a retired person whose objective in investing in a fund is regular income will not be sold a mid-cap fund that is high risk. Hence, selling something inappropriate would be a violation of the rules. SEBI also seeks to ensure a system of documentation and call recording to trace if an investor has understood and is satisfied with the investments he has made. Are the number of new fund offer hoardings along your city roads baffling you? Well, worry not. This week Smart Money tells you if the SBI PSU and Canara Robeco Indigo's new fund offer worth your money. Smart Money asked Morningstar India to give an avoid or buy on these two NFOs. SBI PSU fund intends to deliver long-term capital growth by investing in stocks and debt instruments of domestic public sector units. Morningstar India feels that domestic PSUs do offer an attractive investment opportunity, but there is no reason to believe that existing well-managed diversified equity funds can't benefit from this opportunity. Morningstar feels investors can skip the NFO and consider the fund for investment after it has conclusively proven itself. And since the scheme is an open-ended one, it will be available to you in the future as well. Canara Robeco Indigo Fund is essentially a debt-oriented fund. An element of diversification has been thrown in with the provision to invest 10 to 35% of assets in gold ETFs. Morningstar India feels that investors can enjoy the benefits of being invested in multiple asset classes through this fund. But again, it maintains that though the fund looks interesting, investors should see how the fund manager makes allocations to asset classes over a period of time. Investors can skip the NFO, says Morningstar, because it wants to see how much the fund can differentiate itself from conventional debt funds.
And that's your game plan this week. With that, it's a wrap on this edition of Smart Money. If you have questions, don't forget our email ID, smartmoney@bloombergutv.com. You can also SMS us on 59995. And remember, every Wednesday at 5:30, we throw the lines open so you can join us and our experts will guide you on all your personal finance issues. But until we see you next time, keep saving, keep investing.